one point that's really crucial to make about this and underscores that urgency, both in terms of trying to get China on their heels and get all of the rest of the world together. The Treasury market issue is also urgent because of Janet Yellen's structure of how she financed the deficits. So coming into this year, $10 trillion worth of marketable Treasury debt was due to roll. Total marketable Treasury debt is $28 trillion. So we're talking almost what was 40% or something to be refinanced. Now, I just updated those numbers yesterday because now we're already through the first quarter. So we still have over $8 trillion between now and year end that has to roll. I mean, these are mind-boggling numbers. Our deficit's $2 trillion, but we've got to roll $8 trillion in paper between now and year end. So just to highlight the high stakes gamble that's being made here and the potential to see real dislocations in the Treasury market. Obviously, the reason why $8 trillion is rolling is because the bulk of that, $5.4 trillion, is T-bills. But even out of that, you're talking about $3 trillion of long-dated paper that has to come due. And I've been writing for a long time about this idea of an emerging Treasury risk premium because of our deficits and the shift away from globalization and the absence of our one-time creditors, that you would see a rally in Treasury yields on a recession, but they wouldn't come down as much or as low as they had in prior recessions because the long end would be held up by that sort of new risk premium. And I still believe that. I think there's a further complicating facet of this, and that is this narrative that the tariffs are inflationary, and therefore people talk a lot about stagflation as a backdrop and the idea that, you know, you could have a recession without inflation softening up materially. That's the narrative, and therefore you might see Treasury yields be stickier than we've seen in prior recessions because, you know, there's a hotter inflation component to it. I have serious doubts about that. It's not clear to me that the tariffs are inflationary because in aggregate, yes, okay, so certain goods that are subject to the tariffs may go up in price, assuming that the exporters are willing to let the prices be passed through to their purchasers, the U.S. importers, and those U.S. importers are willing to then let those price increases get passed on to their consumers. But it's not clear that if the consumer ends up having to pay a higher price on XYZ, that they won't cut back on something else to make room for those higher prices on the things that they absolutely have to pay for. And so I think in the aggregate, I have a hard time seeing a slowing economy where inflation's accelerating on tariffs, because we just got a consumer credit number on Monday was negative. You know, they're not borrowing anymore. Quite the contrary. They're like, we can't do this anymore. And their real income outlook, based on those University of Michigan surveys, is almost the worst in history. So they don't have the willingness or capacity to absorb higher prices across the board. So if tariffs increase the price of cars, well, maybe they'll just drive their existing car longer, or they'll, if they have to buy a new car, they'll not take the vacation, or they'll, you know, eat tuna fish instead of steak, or whatever it is that keeps the overall inflation level static. Well, it does from the standpoint of the impact, not just of the tariffs themselves, but more the financial market consequences of it. So both the volatility in the stock market, which is already, we talked about restraining capital spending and hiring, which will dampen the economy, but also the backup in Treasury yields. We're seeing that unfold at a time when credit spreads are also widening. So that means not only are Treasury yields going up, but corporate sector borrowing costs are going up even faster, which was surprising to me. I figured, given this route in the Treasury market, that maybe spreads would actually be tightening because the corporate market would be struggling to keep up with the sell-off in Treasuries. But in reality, people are flying risk even faster than they're fleeing Treasuries. So credit spreads have blown out. And just, you know, importantly, we talked about this last year with the parade of corporate bankruptcies that we saw when corporate borrowing costs were lower. We have seen 150 basis point increase in junk yields in not even a month. I think they were 7.13 just a few weeks ago, and now they're 8.63. It's a stunning increase in borrowing costs, and the corporate sector, by way of reminder, has to roll roughly $900 billion of debt this year, and then another 1.2 trillion when they get done with that in 2026. And then there's another $1 trillion plus in 2027. So there's no relief coming in the pipeline for them. And they've all done this sort of extend and pretend on the idea that by the time they got to today, rates would be lower. And instead, rates are surging. So that, I think, is the other thing that would be a compounding factor for a recession, is you've got the hunkering down amid uncertainty around the tariffs, but then you also have the financial blowback from the higher interest rates and lower stock prices that will hit and reverberate through the economy as well. This is turning upside down the entire operating world that we've lived in for the last 4 decades. Pretty much since Reagan and the fall of the Berlin Wall, we've lived in a world where the US consumer was the center and the rest of the world was sending us their money so that we could buy their goods, and everyone was happy for a while. And then we reached this point where we looked down and discovered we had no manufacturing sector. The middle class was being completely destroyed, and we had completely financialized our economy. We had gone from manufacturing, real men building real stuff, to just shuffling paper claims around over, digital platforms. So that was really hollowed out the middle class. And then you get someone like J.D. Vance out there who really experienced that firsthand, who can articulate it and, help push this message that we're going to restore all of that, bring back the manufacturing and whatnot. But like you said, this is not something that you flip a light switch and it happens tomorrow. These are long-term projects. And yes, Trump has a limited amount of time to lay the foundation for it and get everybody on board and get them to see that there is a light at the end of the tunnel, and it's going to take a little pain to get there. But he has to get that hard stuff done quickly. And so I think you're 100% right that near term is going to be extremely uncertain and extremely bumpy and could be very painful and a lot of dislocations. But in the process of setting us on a long-term sustainable footing where we have a vibrant, self-supporting economy that doesn't rely on artificial stimulants forever. I mean, we basically relied on artificial monetary and fiscal supports for the better part of the last 20 years, for sure, since the dot-com bubble bust. And it obviously accelerated dramatically following the global financial crisis and then hit warp speed with COVID and the post-COVID monetary and fiscal response to that. But these are completely untenable, unsustainable economic foundations. And we sit here and we thumb our nose at China as a bubble and whatever. We are no better. And so what Trump is trying to do is set us on a sustainable footing to reset the economy. It's exciting if it's successful, because we could, for the first time in my investment lifetime, actually have a market where we can buy fantastic US companies at valuations that are screaming bargains. I mean, I can't wait, and I will say this as a gold bull who's been bullish on gold for years. I can't wait to have no gold in my portfolio and have a portfolio that is just chock-a-block with Coca-Cola and McDonald's and Walmart and all of these great companies, but not at these valuations and not in an environment where we're still toting this massive leveraged construct that needs to be, all those excesses need to be cleansed from the system. Doing that's going to be painful, but it's going to be incredibly cathartic and ultimately incredibly bullish for the US economy long term. But for once, we have an administration that's thinking like China. They are looking at the 100-year picture, right? And we've been looking at 4-year pictures forever. This is a major change that we're undertaking. And we have no idea. We've never been through this before. I think they definitely need to message better. Although when I listen to it, I hear that message. Like Trump talked about how there's going to be disruption, but they need to, like you said, phrase it in a way that the average guy can relate to and say, well, this is what it's going to mean for you. This is what it could look like and what could happen. And this is why it's going to be okay in the long run. And it's worth whatever disruption ends up coming to your doorstep is actually going to end up being temporary. And you'll find out that, ultimately it'll be better in the long run. They have to come up with a way to message manage that better. I agree. Because, especially when the markets are this volatile, when you have the markets down, 1,800 points a day and the administration is silent, they should really be coming out saying, look, we thought this kind of thing could happen, and this is just natural part of the process. But maybe they need to hire someone who can come out there and just be the messenger